I think one of those crazy weeks, like you say, I think positioning is a huge, huge part of what's going on. We always see this. Remember in November, Thanksgiving, liquidity dries up. And we have seen this for the last, I think, 5 years now. Massive, massive pullbacks. And then we do stabilize eventually in December. I don't think it's any different year-end book squaring. But also, I think higher interest rates are making matters worse because we have a lot of inventory management happening kind of at year-end by refiners, by physical oil traders. And right now, with the higher interest rates, nobody wants to hold any inventory. So I think we're seeing more destocking as well. All of that combined, in fundamentals, yes, they are weaker seasonally, but they haven't weakened to the point where we should go from $97 to $77 in Brent, right? Like that's just happened over a matter of a month.
Amrita, so many questions. I'll pick up on destocking, actually, because one of the reasons why people said oil went up earlier in the year was the fact that the Chinese were stocking all kinds of stuff, including SPRs and what have you. Now, again, but also I've read from Goldman's and others about the great destocking in a whole host of different commodities as well. And that's why we've seen some interesting price movements there as well. Just what's the latest on your view on Chinese demand? Really simple question.
Yeah, I was there last week, just got back. And I think what's amazing there is that demand is fine. I think in the West, when we look at China, we focus too much on the PMIs, at least for oil. It's far more consumer driven today post-COVID with gasoline and jet doing very, very well. Even petrochemical producers we met with, housing market isn't great and petrochemical margins are really weak. But they were very clear in saying demand is actually okay. Inventories are low, but it's the overcapacity that has been built up that's driving a lot of this. China themselves have been destocking about 600,000 to 800,000 barrels per day on the crude side, but that's from the commercial side of things. SPR, they were buying it, then they paused it during the rally. We understand after the trip that they've restarted buying it. But the SPR volumes aren't that big, Steve, about 20 million barrels, give or take, by March of next year. So that's at the margin. But of course, it helps, right? Because you are going to see more Chinese buying in the coming months, a little bit at least, supports Dubai, supports Brent.
Amrita, can we talk about the links to the monetary policy cycle? I mean, typically high oil prices precede a recession, and now we're talking about a lower oil price as the market contends with a slowdown. How do we see the linkages between the two going into 2024?
I'll say all historical correlations, Karen, have completely broken down. I mean, that's one of my biggest headaches as an analyst. None of those old relationships hold, partly probably because, we've had 10, 12 years of zero interest rates and now it's higher. For a lot of businesses, this is new. And I think one of the key things you're seeing in oil is that it tends to price in any of these macro fears quicker than any other asset classes. And to your point, oil demand, again, slowing, but it's still growing. We've seen some outperformance in non-OPEC supply. I think that's one of the reasons why we've come off a little bit. But none of this suggests that or none of the data suggests that we are going into a deep recession. Our view is that we will be in a mildish recession in the OECD, US included. Our demand numbers reflect that. But, just the way the market's trading, sometimes it feels like none of the asset classes know anything about what's coming. And it's just oil that's telling us there's a hard landing in the US.